I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a bit of a regular guest, Michael Pento of Pento Portfolio Strategies. Also, Pentoport.com is his website. Michael Pento, thank you for joining us today on USAWatchdog.com.
Thanks for having me back on again, Greg.
We're talking about these rate increases, and you brought up on a previous interview, you weren't talking about the rate increase that's coming or they're going to do. You were talking about the dot plot,
right,
and that this is about some sort of normalization of rates or raising interest rates in a band. Could you please explain what the real goal of the Fed is?
So the Fed isn't going to do a one-and-done rate hike scenario like Wall Street would like you to believe. They publish something, they being the FOMC, their intentions of where they think the Fed funds rate, the overnight intra-bank lending rate will be at a certain point in time, the end of this year, 2015, and the end of next year, 2016. At the end of next year, 2016, the dot plots indicated, the median dot plot indicates it'll be around 1.5%. on the overnight lending rate. So the Fed is not going to raise one time and retire and go home. And that's not even the most important point. The most important point is that we have a condition now where we're entering into a global recession. And this global recession is going to occur even if the Fed did not raise interest rates more than one time. It's happening now. Even if they stood at zero for as far as the eye can see. We've had business cycles prior to the Fed's inception in 1913, and we're having a normal business cycle slowdown. But it's going to be much worse than normal, I can promise you that.
Why is it going to be much worse this time? Is it because of all the junk bond funds? They're going crazy. You're seeing all these big, you're seeing all these big hedge funds with huge redemptions going on. What's happening behind the scenes in your financial
I'll tell you why
world?
it's going to be worse. Is the normal business cycle works when you have an excess of savings in the banking system. Then people take out that savings, they go into debt, the economy expands. The Federal Reserve raises interest rates a little bit, cuts off the money supply growth, and we have a little bit of a recession. But that's not what's happening right now. We have had an unprecedented manipulation of interest rates for the last 7 years. The Fed funds rate has been at 0% for 7 years. Never before in the history of global economics have global central banks all pushed artificially the borrowing rate down to, in some cases, negative terms in Europe. This is a coordinated manipulation of interest rates such as the world has never seen. And we're going to start seeing, in fact, you've already started seeing the blowout of this, and it's happening first in the highest risk interest rate sectors of the economy, such as junk credit.
And do you think that just the junk, because the junk just grew and grew because everybody thought that the Fed would have a put under this and we keep everything at at or near zero and kept the foot on the gas and the easy money policies. So do you think junk is enough to cause what you wrote a book about in 2013, and people should go out and get this because this is kind of like the roadmap that's unfolding, the coming bond market collapse. You wrote that book, the coming bond market collapse. Is this the beginning of the coming bond market collapse?
I think it is. One of the most elemental principles of an economy is the cost of money. And like I said, that has been artificially manipulated to near zero and below zero in some cases for 7 years on a worldwide basis. So it's almost like we had the subprime crisis where everybody was trying to convince you that the subprime crisis was contained. It was a very small subsection of housing, and housing is a small subsection of the economy. It's not true. You're seeing the bursting of this worldwide credit bubble, and the first cracks are appearing in junk debt. Now, junk debt went from $1 trillion in issuance to $2.3 trillion in issuance. That's the first to crack, as I said. But what about securitized auto loans? They've gone up 300%. The subprime auto line market, which, by the way, has AAA ratings, is up 200% since 2007. Global debt is up to $230 trillion. That's a $60 trillion increase since the Great Recession. And all of this debt has been issued at artificially low prices. What I'm trying to get across to you and your audience is that the global economy has never been more addicted to 0% interest rates ever before in the history of economics, in the history of the world, in the history of investing. And you're starting to see that crack. And that crack is going to occur whether or not the Fed goes from 25 basis points to 50 basis points tomorrow at 2 p.m., Thursday, 2 p.m., December 16th, or if they go to 1.5%, if they fulfill the dot plots. The business cycle is not something the Fed invented. It's happened throughout time. And and look at this, the business to sale, the inventory to sales ratio is headed into recession territory. All of the metrics I look at are screaming recession outside, exogenous of the Fed's rate hike.
So why is the Fed, if they see all these, they see what you see. I mean, they have hundreds of economists. If they see the global economy...
Overpaid economists, Greg.
Well, God, if they see the global economy spinning downward, why do they feel like they're forced to raise interest rates? Are they trying to protect the dollar? Are they trying to protect their credibility?
I think Yellen has boxed herself into a corner. As I said, as everybody knows, she's been at 0% since December of 2008. She wants to make people confident in the economy. She's trying to fulfill that confidence by going off zero. She's not comfortable being at zero. Other members of the FOMC aren't comfortable at being at zero for so long. And it's just a matter of saying, hey, look, we solved the problem, which was caused by debt and artificially low interest rates, by lowering interest rates and keeping them there for 7 years, and by adding an extra $60 trillion on top of the global financial system and debt. That's what she's trying to convey to you, that we are able to get off zero. Look at us. But they're ignoring the fact that the Baltic Dry Index is lower lower today than it was at the nadir, the lowest point of the Great Recession. They're ignoring the fact that commodity prices, 19 commodities, separate commodities, not just oil, is at the nadir of 2009, March of 2009, lower. So what is that telling us? Is that not saying anything about global demand? Is that not telling these economists that China is slowing rapidly, that 55% of their economy was based on investment, and that's unsustainable, and that's not an easy transition from a 55% investment to a service economy? What about Brazil, which is in a depression? Or Canada, or Russia, or Europe? The entire world is slowing rapidly, and it's happening even under the auspices of QE in Europe and QE in Japan. It's happening because the Fed didn't invent the business cycle, and the business cycle is turning us into a global recession.
Could the Fed raise rates and then in a few months have to completely backtrack? And if they have to do that, aren't they going to have zero credibility right along with zero interest rates again?
Well, Greg, that's why they're going off zero. They're going off zero just to maintain the illusion of credibility. But as I said before, if commodity prices keep falling and global GDP keeps falling and the manufacturing recession that we're experiencing right now in the United States metastasizes into the service sector, and the ISM readings are telling us that's exactly what's going to happen, Janet Yellen will be at 50 basis points on the Fed funds rate. Maybe she gets to 75 by March or June of next year. But that doesn't obviate the fact that she's going to have to take all those back and enter into QE again, just as the ECB and the BOJ are doing right now.
She's not going to let the economy sink in an election year. My goodness sakes, she's a Democrat. She was picked because she was a big Democrat. I don't mean to politicize the Federal Reserve, but that's a known fact. So she's going to let the Democratic Party sink into the oblivion and keep raising rates in the 2016 election cycle?
Well, here's where I come down on this, Greg. The Federal Reserve is going to slowly hike interest rates, and I'm going to emphasize slowly. Now, I'm going out on a limb here saying what she's going to do tomorrow. She's going to hike by 25 basis points on the Fed funds rate and then really apologize for doing so. But as I said, that doesn't change the intractable motion towards a recession. So she's going to have to take back that interest rate hike. She goes back into QE sometime in 2016, and there will be congruence with the Fed's monetary policy and the ECB and the BOJ. I think the U.S. dollar is really in jeopardy here because The dot plots indicate we're going to be at 1.5%. I don't think we ever get there without completely flattening out the yield curve and sending the U.S. economy into a depression. And if that's the case, how the heck can the U.S. dollar maintain where it is on about 98 on the DXY? I think it rolls over. I think it rolls over hard.
How can, if we're going to have this big bond implosion, I suspect you mean all of them, including treasuries.
Oh, junk, leveraged loans, student loans, car loans. Like I said, the securitized auto loans with AAA ratings are up 300% and 200% increase in the subprime, which is, I think, is a 640 credit rating. The whole economy has become addicted to easy and free money for 7 years, and you're seeing the cracks in junk. But it's not limited to junk. It's everything. It's sovereign debt. We have $18.8 trillion in outstanding U.S. debt right as we speak. That's an increase of $10 trillion. Can we service that debt when the one-year note is 2% instead of where it was at 0.1%? No, we can't. And that's the same in Europe and the same in Japan and the same in China. We are globally addicted to ZIRP. ZIRP will be here forever. But when they try to take away ZIRP, as Janet Yellen is doing right now, watch the blowback, what happens in the economy and in markets. It's going to be very ugly.
Couldn't all these derivatives that we have, I know Bank of International Settlements tags it at a quadrillion.
Hundreds of trillions, yes.
I mean, let's just use the official number, a quadrillion. Some people say it's two and a half, three times that. I mean, much bigger. Yeah. But let's just use the official number because it's a big number, a quadrillion.
1,000 trillion in interest rate derivatives.
So could that just go crazy? I mean, could it sink the whole economy?
Yes, absolutely. But that's just one part of the puzzle. What's going to happen to the real estate market when banks stop lending money completely? What's going to happen to the auto loan, student loan market, leveraged loan market, the whole entire economy, by the way, which has never grown above 2% annually since the Great Recession ended in 2009, in 2010, 11, 12, 13, 14, and 15 will be a 2% reading on U.S. GDP. It's barely growing. And that's even despite the fact of double counting parts of GDP and misreading inflation. Because all the inflation they've created is, where is it? It's in the bond market, in the stock market, and the real estate market, which the Bureau of Labor Statistics fails to capture in their CPI measure.
So when do you think you tagged this bond market, you predicted the bond market collapse. When do you think the bond market collapse finally happens?
Well, I'll tell you why it has to collapse. Yep. It's going to have to collapse because the Fed is going to be stuck at zero. The ECB is going to be stuck at all central banks are going to be stuck near zero for as far as the eye can see. So eventually these bond markets are going to collapse. Why? Due to inflation. Now, if you don't believe that, if you're going to tell me that a central bank a global central banks can keep interest rates at zero forever and never engender a rate of inflation, then I'll tell you this. You're telling me that real GDP growth is going to be stuck close to zero, as it is now, across the globe. And you're going to be telling me that nominal GDP, which is just 2.7% in the United States, is going to be stuck right about where it is now. If you have nominal GDP growth, no inflation, remember that's the argument you're saying, the bond market's not going to blow up because the Fed and central banks can't create inflation. What you're saying is that nominal GDP growth will never be more than around 2.5% to 3%. And if that's the case, the tax base needed to pay off our debt and service our debt is not going to be there. And then you're going to have a situation just as you had in 2012 in Europe, where the bond market vigilantes say, hold it. Look at your debt to GDP ratio. For example, in the United States, forget about the debt to GDP. Everybody knows it's over 100%. It's about 103%. Look at the revenue to GDP. Look at the tax revenue to debt. We have about 600% of our debt to revenue. That's the most important metric. We don't have the revenue. Forget about GDP. We don't have the revenue to service debt. If you went to your local bank and said, I want to take out a loan, and here is my revenue, and my debt is going to be 600% of my annual revenue, the bank would kick you out of the door and laugh at you all the way to the parking lot. That's where we are. We're about 200% over what a bank would make a loan. if you want to look at personal loans to government debt. We are insolvent as a nation, and it's going to be even more the case as this wave of entitlement programs kick in 2018. So is the bond market going to blow up? Absolutely. Interest rates are going to rise either because inflation or because the tax base isn't there to service the debt outstanding. And when interest rates rise, that is when the real pernicious debacle and chaos begins. Not my fault, not USA watchdogs' fault. It's the fault of these artificial low interest rates that encouraged increases in debt, encouraged astronomical increases in asset prices, led people falsely to believe that this debt can be serviced forever, and it cannot. And when that implodes, watch out.
What's the time window on that? Does it all happen before 2020?
Yes.
2018?
Yes, 2018. 2018 is when you see annual deficits go north of $1 trillion here in the United States. You're going to be spending about 30 to 50% of all of your tax revenue just to service the debt. That's going to wake up these bond vigilantes. If the U.S. nominal GDP growth is going to be staying around 2.5% all the way through to 2018, then I think you're going to have a debt crisis similar to 2012. Don't say it can't happen, because in 2012, Greek debt, Portuguese debt, Spanish debt, Italian debt, Irish debt went from quiescent levels of low single digits all the way up to 40% in the case of the Greek 10-year, and in 350% in the case of the Greek 2-year. So it can happen outside exogenous of inflation fears.
Do you think the wheels could come off earlier? People like David Stockman says this whole thing comes apart before the election cycle ends in 2016. Could it come off earlier?
I kind of think, viscerally speaking, Greg, I kind of think that Janet Yellen's going to raise 25 basis points and really apologize for it. We didn't mean it. We didn't know what we were doing. We'll never raise again, blah, blah, blah. And that could engender a short-term rally in the stock market. That's my visceral gut feeling. But as I said before, we are entering into a recession in 2016. And if I'm correct on that metric, then annual deficits will once again go back to 1.4 or 1.5 trillion dollars. And if that's the case, if I'm right on that, on the recession, and I know I'm right on the annual deficits, what is Janet Yellen going to do? What is the Fed going to do? The last time we went into this debacle, this crisis, the Fed funds rate was 5.25 in 2006. They had aggressive move on interest rates. They also could do the QE programs, which have never been done before, to push down long-term rates. The Fed funds rate was 5.25. Now the Fed funds rate is practically zero. It's on the effective Fed funds rate, it's 12 basis points. What is she going to do? Take back the 25 basis points? We already know QE is ineffectual. So in other words, what I'm saying, the ammo for the Fed and the credibility of the Fed has been greatly attenuated over these past 7 years. So if we slip into a recession and the interest and the deficits go back to $1.5 trillion, what is she going to do to placate the market? How is that condition going to be easily mollified? I don't think it can.
They're out of ammo.
That's the real danger.
You're saying they're just out of ammo. They're out of tricks. They're out of ammo.
$1.5 trillion that adds right to the national debt every year on an annual basis, and that could expedite. That will be the progenitor for the bond market collapse. And when interest rates rise, that's when the real problem. Could you imagine what's going to happen to the auto market? The big crow now with the Keynesians is look at how much the autos are doing fantastic. We're giving anybody with a heartbeat these auto loans, and there are hundreds of billions of dollars of these securitized auto loans are being sold to Wall Street, which is a huge hanker for yield. And that's exactly the same condition in the junk debt market and leveraged loan market and derivative market, and on and on and on. What's going to happen to the economy when these rates rise? And I don't think there's a damn thing the Fed can do about it. That's the scary part.
And what happens to the dollar? Does the dollar just, if the bonds are no good, then are the Federal Reserve notes based off the bonds no good?
You have the special drawing rights from the IMF. They just included the renminbi in that basket of currencies. There's a huge move away from the U.S. dollar as the world reserve currency. So all we have left really, and China's been, by the way, I hope your viewers understand this, China has been dumping treasuries like mad, trying to support their currency. So what I'm trying to say is the only thing we have left is Janet Yellen's hard money policy of not doing QE and zero interest rates. So that it's a divergent strategy in the monetary policy regime of the ECB, the Bank of Japan, and the Federal Reserve. I think that goes away. We even lose that in 2016. And if you have the Fed cutting rates going back to QE, the dollar is going to tank like it has never tanked before.
And you think they'll be printing money like crazy? Your prediction is they're gonna have to reverse course and do QE and print money like crazy sometime in 16.
Yes, Janet Yellen said it herself. And Janet Yellen said it herself very recently, I think this week. She said, listen, if we're wrong on raising rates, we'll just take it back. And if that's not good enough, we're going to go back into QE.
Oh.
That's part of the Fed's tools. I'm not making things up. Negative interest rates on the deposit, negative interest rate on the deposit rate, another round of QE. That's all part of their tools, and they will be deployed again.
And do you think they're going to have bank bail-ins? Do you think they could just shut people off from their accounts?
I think that's the new strategy from the OCC and the Office of Thrift Supervision. We're not going to be bailing out banks anymore. You're going to be taking a haircut on your deposits. That's the next strategy. So that's going to be part of the next strategy. But when this whole thing implodes, Greg, I think the printing press is going to be sought more and more, and that's when I think people are going to be. Gold has been the pariah throughout since 2011, 2012, as the deficits in the United States came down, and we were looking forward to the end of QE. The U.S. dollar has been king for the last several years. I think that all comes crashing down, and gold will once again come to the fore as really the only. Forget about Bitcoin. That's Bitcoin, which if the grid goes down, it doesn't work, and there's unlimited amounts of digital currency that can be reduced. As far as I know, God's not making any more elements that are beautiful, very rare, and indestructible. So gold is real and honest money. It'll once again be thought of as that, even from the robo-day traders that occupy Wall Street.
Michael Pento, thanks for joining us today on USAWatchdog.com. His website, pentoport.com. It's Pento Portfolio Strategies. The book, which is on his site, which I'll link to the website, is the Coming Bond Market Collapse, and it's coming. According to you, and you laid out a very good case for why it's coming. Thank you very much for joining us today on USAWatchdog.com.
Thanks for having me on, Greg.